$33,000 over the last 45 trading days since we've built a portfolio. All right, so if you guys have any questions on how to get that built, give me a call or text me 505-322-7515. With that, Jason, I'm going to go ahead and turn it over to you, bud.
Excellent. Thank you, sir. All right, everybody. So America's under attack. Our cities are being looted. Half the economy is unemployed, yet the S&P 500 is rocketing into new highs. What gives? How did we predict this? And why are our clients lining their pockets being long the S&P 500 right now? What's the big move coming? And how can you benefit? Today, we will review all of this and more, but let's just start off by looking at the trading plan and how you can get started immediately. So first off, per $25,000 following the trading plan, we are recommending that you purchase 400 shares of UPRO and then protecting that with 40 XLF 22 strike put options expiring on 9/18. Okay, now if you actually have a portfolio that is under $25,000, then we recommend following our buy and hold no options trading strategy, which is currently long 10 shares of UPRO and 5 shares of SLV with a large portion of your capital in cash. So these are designed to get relatively the same return. However, one trades once a week with no options and is extremely passive. It's really ideal for those of you who want to make the largest return with the least work, but perhaps less protection because you're not using options. Whereas our pro strategy aims to make the safest profit. We're not necessarily concerned about getting the best return, but rather the least volatility and the least risk. Now, if you're an existing member, you have no changes today. Your buy and hold portfolio is not changing anything, and your pro portfolio is not changing anything either. We're simply long UPRO and protecting against the downside by having put options in the US banking sector. So we'll take a look at this analysis and more. Quickly, let's look at our report card. In the buy and hold portfolio, we are doing extremely well. Let me zoom out slightly here. Okay, so the buy and hold portfolio wasn't doing as well in February and March because it can't take advantage of options. So remember, that's when we had that huge crash in the S&P 500, and the Federal Reserve delayed the crash by injecting $3 trillion into the market. So it didn't do as well at protecting capital, but because of our strategy, you can see when the S&P 500 had a 34% drawdown in March, the buy and hold only lost 9%, reducing that by 30%. Today, it's outperforming the S&P 500 and currently up 8%. It's done this with very little work. And again, it's actually pulled this off with a lot of your money in cash. So we're waiting for the right opportunity to deploy the rest of that cash. But because it only trades once a week and does not use options, we do play it safe, realizing we don't have the flexibility as our pro strategy. Now, the pro strategy had one of its best returns in March. And in fact, at one point was up 15% in March until the US Treasury market collapsed because of just how significant this global shutdown was on financial markets. It is currently trading the last 3 months at a positive return of just over 4%. So it's starting to pick back up and catch up with the buy and hold portfolio. Now, this portfolio has 100% of your cash deployed, so it has twice the exposure to the S&P 500 compared to our buy and hold. And the reason why is because we have the safety net under our portfolio in pro, so that as the S&P 500 climbs higher, you will see this track record catch up and outperform the buy and hold. And it's going to be able to do that with extreme protection, leveraging put options. So there are a lot of advantages to the pro strategy, and but it again does take a little more work and a little more capital. Most of the clients following our pro strategy have hundreds, if not millions of dollars following the strategy, and thus they're Again, more interested in protecting capital than absolute return. Now, if we do hop into our leading indicators to predict markets, we can take a look at what's going on. So our basic prediction is that interest rates will rise in the treasury market, which will be negative for primarily the precious metals market. It could create a little bit of a headwind against technology and extremely bullish for the beaten up parts of the S&P 500, specifically banks, energy, industrial. And we are seeing a clear path to a recovery. There does remain a few obstacles. And the first obstacle I would really point out is that the Democrats have no reason to create a stimulus deal, and they are also refusing to reopen their economies. So uh, this this is the single biggest issue heading into the election and the greatest risk to our portfolio. So we're keeping a close eye on that. Uh, but at the end of the day, the Fed is still pumping $80 billion a month into the markets. Central banks globally are printing and injecting approximately $3 billion every hour into markets. And this phenomenon creates rising interest rates and sovereign debt and is extremely bullish for the S&P 500, especially the beaten up sectors. Now, this is the golden copper ratio and is a great predictor of interest rates. So it's no surprise when we unloaded the greatest amount of QE in history, inflation is picking up, and this is driving higher interest rate demands from sovereign debt purchasers. So we do expect that interest rates will begin to rise, and we're starting to see that TLT crack today. So that's been very strong during all of this, despite the massive deficits the US government is creating. This week, we have quite a bit of debt being issued. In fact, let's jump to that. But bottom line is if the copper gold ratio is pointing up, that does predict rising interest rates, which again is great for the S&P 500. It's not that great for tech or precious metals. Or if you're holding treasuries, it's disastrous. So if we look at the debt being issued this week, it's above $300 billion, which is a huge jump. The last several weeks, they were only selling about 100 to 150. So the debt issuance is picking up. And once we get into the next month, we're also going to have corporate debt picking up. So between all of this, stock buybacks are likely to begin ramping up into the close of the year. And we're expecting the S&P 500 to, just by following the money flows, rocket higher, much higher. Now, if we do look at the trends in interest rates at the yield curve, we can see that the interest rates are rising across the entire curve. And this week and every week moving forward, there will be tremendous pressure to drive these interest rates higher. Now, many people were expecting that the Fed would create yield curve control immediately. However, we were predicting that this is not the case and that the Fed can actually create its objectives by standing back and allowing interest rates to rise to a more appropriate level. Now that it's clear we're not going to need lockdowns into the future, then my expectation is we'll see the 20 and 30-year treasuries rise their interest rates significantly, potentially all the way up to 2% before I'll start getting nervous about stocks. So if you do the math and look at the outcome of allowing interest rates to rise, we can look at the market value of treasury debt, and essentially a 15 to 30% rise in interest rates can allow several $1 trillion to exit sovereign debt and rotate into the beaten up parts of the S&P 500, which is critical to creating new job growth in the United States. It's also critical to protect the value and dominance of the US dollar. So that's our big prediction, and it's playing out. The FOMC minutes supported this last week, and essentially there's no intentions to ramp up QE right now, and there's no intentions to do what's called yield curve control. So if we go to the bond market rates, this is the 30-year treasury, and this is the phenomenon when you do quantitative easing. You make rates rise rapidly, which we can see in the recovery in 2009. This is exactly when they began printing money. It happens like clockwork. So that's the prediction. Now the catch is the interest rates cannot rise too high before this could create a stock sell-off. My expectation is to see interest rates go to approximately 2 and then perhaps drive right back down to new lows. Now, this process could take several years to play out, which means our expectations for the S&P 500 could go far beyond many people's beliefs. Also, if we look at competing bond markets, we can see China's interest rates at 3.7, paying out almost 3 times what the US government is paying. So we do need to make our interest rate more attractive. If we go to Japan, you can see despite their worst GDP print since 1979 when their economy collapsed, their interest rates are rising rapidly. Again, a phenomenon of quantitative easing. Now come over to Germany. So this is tied to the hip from China. It does look like there is tremendous weakness in Asia. We're seeing it in their currencies. We're seeing it in the German yield, who's again tied to the hip of the Chinese economy. But even there, we're seeing interest rates rise. Put it all together, and we can see the big picture is that sovereign debt yields are rising, and this is going to push trillions of dollars out of sovereign debt. And when you're in a period of devaluing currencies and rising interest rates, while there's slow inflationary pressure as we recover the economy, this points to, again, wanting to own the value sectors in the S&P 500 and to step away if you're in precious metals. Now, tech has grown its relative profits and earnings through this this fiasco, and consumer behavior may be changed forever. So I'm not as concerned about a significant sell-off in technology stocks as much as I am in a relative crash in debt as well as precious metals. So that's why we are 100% long the S&P 500. It does provide that risk parity strategy simply because of the way certain assets have gotten ahead of others. So let's pull up that chart next so we can look at it.
Okay, Jason, you had a question in from Keith Milson. He said, do you think crypto will follow equities or metals?
Metals. And sorry, guys, I'm reloading my charts here so we can get that breakdown per sector loaded up here.
Nice, Jason.
Yeah, so the big prediction here is that the interest rate in treasuries is going to rise at a faster pace than inflation expectations because it's going to take quite some time to recover the job losses, and that's the main pressure point for inflation. Okay, sorry guys, here is the breakdown. So this is the new risk parity strategy. We have technology up top leading the pack, and then we have all the value in the S&P 500 trailing. So if we're going to expect more lockdowns, falling interest rates, more pain to the US economy, then technology really wins, as you've seen since March. However, if we get a true recovery, we just get vaccinations at work, we get the economy reopened, we stop all this lockdown nonsense, well, then the beat up portions can really catch up. And so this is the new risk parity strategy, and really everything else is extremely dangerous. So let's just look at what's gone wrong with how most investors are positioned.
Then you had a question from Jeremy come in. He says, why was I under the belief that rising inflation is a good thing for metals?
Oh, Jeremy, we're predicting that bond yields will rise faster than inflation, which makes the bonds more and more attractive. John Nolan says, can we exit some of our boot camp trades? Yeah, so I really want to see interest rates start to rise, John, before I'm going to close out any bank put options. We're still seeing the bond market show resilience at this point in time. But yeah, those do overlap to quite a degree. Ed Portman says, why will the TLT be rising? No, TLT I'm expecting will crash. Okay, so let's go through our key indicators here and we'll understand what's happening in all the markets. Okay, so the big risks right now would be most likely to our positioning would be a dollar crunch. So if liquidity is drying up, which it's not, we would see the dollar rising rapidly. Now, the Fed does seem to be trying to tighten up the dollar by allowing interest rates to rise. Rick says, if interest rates are rising, won't it help banks? And if so, why are we short puts? Right, Rick. So you have 3 times leverage on the S&P 500. So what would go wrong for us to lose money? Banks become insolvent. So the put options are designed to protect you when things go wrong, not to make money. They protect you against us being incorrect. So it's called a hedge. We're hedging against our risk by being long the S&P 500. So here's the dollar index. We have Trump pumping up that he's going to make the dollar strong. He just does what they tell him to do. Just look at who's in his cabinet. It's all big bankers. He's clearly being supported by all of the major banking cartels out there. And their plan is simple. It's protect the dollar and get the S&P 500 as high as possible to recover the job economy and get us in a position to go after China. So that's really the big picture here. Next chart, we have Ethereum against the QQQ. Again, this is a great leading indicator of risk. It predicted the March crash, it predicted the April rally, and it's predicting upward move from here. Now, we did see a bit of a sell-off, but you can see it's rebounding quite nicely. Another key metric is to watch the price of oil. Oil companies in America are doing quite well above 40. So anything over that is a cherry on the top. And again, if we saw a sharp sell-off in oil, this would be a great leading indicator that there's trouble ahead for the S&P 500. Now, copper is a commodity that's used when there's growth. So if commodities are going up, especially copper, this signals a recovery. It also signals higher interest rates, which again is exactly what we're hoping for with the S&P 500. And right now it is just going straight up. This is the price of gold. And you can see the second we started getting volatility in interest rates in the treasury market, we have seen the price of gold really struggle. This has a huge downside risk to be long precious metals right now, which the gold bugs are having a hard time digesting. They're having a very hard time understanding that the Fed can do a better job with its goals by allowing interest rates to rise, by not ramping up QE, and essentially forcing trillions of dollars out of sovereign debt markets as well as precious metal markets and flowing that into the banking sector. When we look at the two combined, we can see that since the March crash, when we began printing money rapidly, copper has begun outperforming gold, again, signaling rising interest rates. If we zoom out a bit, we can see that gold was outperforming copper leading into this crash, but that trend is changing. Our expectation is copper will cross over gold. Here's a bigger picture. We can see these two are constantly fighting over capital and are constantly crossing over. And again, this is exactly what we're predicting is pressure on precious metals as uh, copper rises higher. Here is silver's chart. Everybody's trying to play that 2010, 2012 melt up in the price of silver. But I am concerned that there could be significant volatility in precious metals. Now, in the boot camp, we have a long duration call option, and we haven't exited this yet. We're still not seeing the treasury market really melt down, which is what would cause me to exit our short positions in banks and silver. So as soon as we get a little more confirmation on that, we'll be ready to look for different hedging opportunities. But right now, that's still not quite the case. We're seeing little bits of fits in the treasury market, but in general, it's still hanging in there, which is still very good for the S&P 500. It means we have very little risk that there'll be a liquidity crunch. The government can sell its debt at a low interest rate and continue to stimulate the economy. Now, here is one of the most important charts and why our favorite strategy no longer works. So we're a huge proponent of the risk parity strategy, which Ray Dalio has made famous. Just about every big hedge fund, pension fund, central bank in the world uses this strategy. They go half into stocks and they go half into sovereign debt, and that's really simplifying it. And they tend to protect one another. But because the Fed has forced interest rates to remain low, the risk reward on treasuries is terrible. In fact, you can see these two have gone up during the same period of time, which should not happen. They need to go the opposite direction to provide the value to the risk parity strategy. So this is perhaps the nuclear winter for risk parity, which is again half long treasuries and half long stocks at the same time. The problem is you may lose more in your treasury position than you stand to gain in your stock position because this is so dramatically overpriced. In fact, the treasury market is basically priced in that we're going to remain locked down for the next year at least and completely collapse the economy. And the scary news is that Joe Biden is openly telling everyone he's going to lock down the country for another several months if, quote, the scientists tell him to do it, which of course is the $50 billion budgeted NIH, who is controlled by the different drug companies. So that is a huge risk. If Joe Biden wins the election, I would expect to see the economy re-locked down. Most small businesses continuing to not be allowed to operate at full capacity. He has said he'll do a mask mandate, even though all the data is crashing by the day. By the time we get to the election, most of the states who have opened up will have next to no cases. So there's really no excuse for this policy stance, except for malicious intent. So that is again the big risk here heading into the election would be more lockdowns if Joe Biden does win. Here's the gold to silver ratio. So we're seeing silver start to outperform gold. Now I think we are again at a risk of a several month, perhaps up to a year pullback in precious metals. Now again, I won't change our positioning in the boot camp until we see interest rates really starting to rise. That will be the trigger to look at different hedges in our portfolio. Until that happens, it is signaling that the banking sector is still at risk. So they really need to recover for the S&P 500 to drive to new highs. So we're hedging the riskiest part of our portfolio where we're also expecting to see the most growth. Now, if we zoom out on the S&P 500 against the TLT, what we can see is the way it's supposed to work. And so specifically, if we go look at the 2008 crash, Here's the way the risk parity strategy is supposed to work. When your stocks crash, your bonds go up. When your stocks rally, your bonds sell off a little bit, and it makes it a beautiful hedge. But this time is different. The Fed has had to stimulate the treasury market by suppressing yields, and now they do not provide that value. And so this is very problematic. Now, the Fed has a few options: allow interest rates to get back to a realistic level that's attractive, so the risk parity strategy works once again, or they can risk the sovereignty of the dollar by going aggressive with QE right now. My prediction is that they are going to be motivated to allow interest rates to rise and allow the markets to begin functioning a bit more normally now that we do have a clear recovery on hand. John Nolan says, do you think ongoing forbearance issues will harm banks and ultimately harm the housing market? Yes. Yeah, no, there's a lot of structural problems in the economy. But right now, we can get away with trillions more in stimulus. So that's one. And two, we just got to look at the money flows. Where is the money going to flow? It's going to exit precious metals and bonds and flow right into the S&P 500. Jeremy says, do I think cryptocurrencies will go sideways or fall depending on interest rates? No, I think if the treasury interest rates rise rapidly, it'll crush cryptocurrencies. Crush. But it's not happening yet, so we're keeping a close eye on that. Now, if we do look at the NASDAQ against S&P 500, once again, our expectation is for the S&P 500 to begin outperforming the NASDAQ. And this is one of the first days we can say that's happening. SPY's up 0.65 while the QQQ is up 0.5. So I think the technology companies, again, they have actually grown. They've increased their market share, and consumer behavior very well could have permanently changed in a manner that will help justify much of the valuations of tech companies. Now, on the other hand, the reason to own precious metals and cryptocurrencies could be at risk, because if bond yields do rise rapidly, that will become a very attractive investment. And again, it's going to just suffocate these risky assets that really provide no value. Besides, it's kind of the worst case scenarios. We need to go buy some gold and cryptocurrencies. But what are you going to really do with it, right? You're going to convert it back into dollars if you ever want to buy anything. So you have to have the perfect conditions to be long either of those two assets, in my opinion. And the risk right now is simply not worth the reward. Now, again, once these interest rates do reset, that's when I would want to get back long gold. So I do expect to be picking up treasuries and precious metals after interest rates are closer to 2%, which I think is about the maximum change in interest rates that the markets will handle. Now, again, every correlation you know of flip-flopped the second we did that $3.5 trillion purchase in March of US debt. And so gold went from tracking the stock market to now being correlated to the bond market, which we can see with this overlap of the TLT against GLD. And so again, you can see that volatility in treasuries right here in the candlestick, and the immediate reaction to precious metals. So if this continues to sell off as expected, get excited, because in the long run, there's still a lot of damage to the economy that's going to be diluted with lots and lots of debt and lots of money printing. It's just in the next 6 to 12 months, the Fed is really incentivized and motivated to allow interest rates to rise. It helps them accomplish all their goals with the least work.
Hey, Jason, and Neil has his hand up.
Okay, great. Let's go ahead and take a question from Neil.
Okay, and Neil, if you haven't used the Zoom technology before, bud, the microphone icon is going to be in the bottom left-hand corner of your screen. When you tap that, that will unmute your microphone, and then you can just ask Jason any questions you have here live, bud. And thank you, Neil, for raising your hand. Anyone else out there, if you do have additional questions, please feel free to go ahead and raise your hand, okay?
Okay, Neil says, what sectors of the SPY? Well, yeah, Neil, I don't think you should just buy the banks, which I do think will be the best performer here, and in industrials and energy.
You were
It may,
short.
yeah, it makes more sense to own the S&P 500 because now you have that risk parity strategy within a single asset. Go ahead, Neil, you got your audio up.
Yeah, so you were short on the S&P 500 banks, right?
I'm hedging our risk with put options in the banks, but I'm predicting that those will rally the strongest.
The banks will rally the strongest?
Yes.
Thank you.
You're welcome. Yeah, so we're always going to buy put options on what could go wrong. So we've got our positioning betting the S&P 500 will break into new highs. We finally did that. Took about a week longer than I expected. But the potential for the S&P 500 is to rocket much higher here, not based on valuations, just based on money flows. There is way too much money long treasuries. There's way too much money long the dollar. And essentially, what's happened this year is everyone has reduced their positioning in stocks. So if they just sit back and allow interest rates to rise, this will shove trillions of dollars out of these different markets. So I'm not too concerned about technology companies getting crushed. And I expect the banks to really deliver most of the gains. That's why if we're wrong, once again, technology stocks continue the climb, and the banks are the riskiest asset right now when you look at the big picture. No one's paying rent. Businesses are going bust. Bankruptcies are at all-time highs, especially in the billion-dollar plus market cap this year. So you want to hedge the riskiest part of your portfolio. Technology companies are really set to jet. I mean, they have taken over more market share in the last 6 months than they ever have in history, and these changes could be permanent. So again, the S&P 500 provides the right risk to reward ratio and balancing of your assets when we look at all of the other options. Bonds really need, for the bond market to deliver profits from here, we would have to lock down the economy into next year and just collapse everything, which unfortunately does seem to be what most Democratic governors and leaders are trying to do. They say it's to save lives, but I would argue that that's not what they want to do. They want to destroy the middle class because that's their whole model. They bribe you with welfare for a vote. So if you have a good income, you're much less likely to vote for that party. Now we're ready. If Joe Biden wins the election, we know exactly where to put our chips. And so we are tracking that closely. And again, it's not my job to make you be a Republican or a Democrat. It's my job to help you make money. So again, I don't care who wins. From that standpoint, we are ready to profit depending on who wins this election. Okay, so let's look at the banks relative to treasuries. So once again, this shouldn't be happening. Treasuries don't go up while banks go up. Okay, they need higher interest rates to have a profitable business loaning money out. And so if we do zoom out and look at the normal relationship, in fact, let's go back to 2008. You can see this relationship when interest rates are rising, TLT's crashing right here. Banks rocket higher. So these banks went from a relative 75% decline and skyrocketed higher as interest rates rose from the TLT selling off. Now, most of this doesn't really have anything to do with the health of the banks. This is simply a phenomenon of doing quantitative easing, which I'm expecting to be done for the next 12 to 24 months, and slowly but surely get more aggressive with QE. Right now, the Fed, again, is incentivized to do less QE to stabilize the banks, to drive the S&P 500 much higher, to restore job growth, and to protect the dollar. So they can do all of this by just simply sitting back. And they're basically going to steal a couple $1 trillion out of precious metals and sovereign debt worldwide without having to, again, weaken the dollar by printing too much. Now, this is probably about to be another massive catalyst for corporations. They have borrowed more money than they ever have in history from corporate debt, and they're expected to do massive debt issuance next month. And what do they like to do with that money? Well, they like to buy back their own stock. And so this year has been one of the weakest years of stock buybacks, but I do anticipate to compete with other stocks, you're going to have a massive stock buyback program. So you're competing with Apple, Microsoft, who are just as fast as possible shredding up all the outstanding shares so that the same number of outstanding shares become worth more. So they don't even have to grow revenues to make their stock valuation rocket higher. All they have to do is borrow cheap and buy back their own stock. So the purple and green line show us that, especially for the top companies, the interest rate to borrow is the cheapest ever in history. Think about that. The cheapest ever in history for Apple, Microsoft, all these big dogs to borrow. But we're near all-time low interest rates for everyone else, which is good for, again, the S&P 500. Okay, here's a look at Wells Fargo. This is one of the systematic risks to the market. They have a huge portfolio of mortgages, which, again, many people aren't paying their rent. They're not paying their mortgages. And we've really just delayed this pain. So this is yet to be felt. Most likely, these banks need big bailouts. Question is when they'll get it. And again, this is one of the key stocks to watch in the US. It's the weakest bank with the most liabilities exposed to this crisis. So again, if we don't allow small business to reopen, we have all these crazy rules where you can only have 25% capacity. What do you expect is going to happen? The other big bank to keep a close eye on is HSBC Bank, a huge London-based bank. And this is already trading right around 2008 levels. Now in the boot camp, we are playing this by shorting the Hong Kong dollar. Currently at 13 cents, I'm expecting a Trump victory and a lot of pressure on China directly after the election, which could collapse the Hong Kong real estate market and thus their currency, because they just don't have enough money to protect that real estate market and thus their currency. So if that were to collapse from 13 cents to a penny, our clients stand to make 100 to 1 returns. We have a 1% position shorting the Hong Kong peg. And we look at HSBC Bank simply as an indicator of the health of that area. And so it's at depressionary levels. 2009 was the last time HSBC Bank was trading at this level. Now, on better news, Deutsche Bank, which is, again, the German bank, highly connected to China economy, is trading at decent levels. So that is, again, signaling that some of the banks are showing strength here. Okay, Mukesh Patel has a question. Go ahead.
Jason, can you hear me?
Yes, sir.
Okay, cool. Jason, what's happening in CMBS market? I'm in the hotel industry, and a lot of our friends and acquaintances are exposed to the CMBS loan, and the hotel market has just crashed.
Yeah, it needs a big bailout is what it needs. It's in
You think
serious
it's
trouble.
gonna happen? You think it'll happen?
Well, we have a lot of put options on the banking sector if it doesn't. I'll say that. That's a big risk, an extremely large risk.
Okay.
So I think the Democrats are going to refuse to do any stimulus and try to create as much chaos as possible. So yeah, that's a big risk and why I have us loaded up on put options and financials.
Got it.
Right now, the market is rewarding investors to take on the greatest risk. So the greatest risk right now is to have that exposure to the banks. That's why you get the greatest return, and why we're hedging with, again, put options in the financials. This whole recovery relies on bailing out these banks. So we've given people the permission to not pay their rent to get through this. We've forced businesses to shut down. So there's going to have to be a big bailout to make up for all these unpaid months. So again, that's critical to the recovery. It has to happen. If it doesn't, we have a major crisis on our hands. But you are protected. In fact, if the banking sector collapsed, we could still see technology hanging right in there. Because think about it. What would that really mean? It means we're not reopening the economy. We're not supporting the banks. And money's going to flow right into those tech companies again. So we have the right hedges to protect against a collapse in that sector, which I do think is a serious risk. Absolutely. Great question.
Thank you.
Yeah, the hotels are really hurting right now. Everyone in real estate's hurting right now, unless you're selling new houses. But very good question. Very astute. Here are emerging markets. So you could argue that we never began a new bull market since 2018 with world stocks, and that money has just been flowing to the US as a safe haven investment, not because there's growth and a long-term recovery. So it's critical that the emerging markets can break past the 2020 high and march on higher. So this is starting to look strong here, but again, it's still not past that 2020 high, and it's nowhere near the 2018 high. Next big market to look at is Europe. Again, this is in worse shape than emerging markets and does signal more of the safe haven investments in the US. So what's the US's biggest advantage? It's the dominance of the dollar. While everyone else could only stimulate their economy with $1 trillion spread out over a year, the US was able to take advantage of its dollar dominance and inject $3.5 trillion in a month. So it's no wonder our markets are so much stronger than everyone else's. So once again, to get a long-term recovery, we need to bail out the banks. We need to get Asia up. We need to get Europe up. So that's why we're watching those, but not investing in them. Now, the volatility index is great. I guess there's some sort of mini crash in the VIX index today. I haven't read up on that. But the bottom line is the cheaper the VIX is, the less expensive it is to protect and ensure your S&P 500 position. So this is just beautiful setup for the SPY. Probably the best setup I've ever seen in history, because there's nowhere else to invest. If you buy bonds, you're really betting that Joe Biden's going to win and just collapse the economy by design. Otherwise, bonds are a horrible investment right now. If you buy precious metals, you're betting the same thing. But we have a clear path to recovery. The FOMC minutes are confirming our prediction that we made, which is that the Fed will stand back. They're going to stand down and let the market do its work naturally. Okay, so here's the breakdown of the different sectors of the S&P 500. This is the best investment in the world, bar none. It acts as a safe haven for securities. It has the risk parity characteristics built into it because of this big discrepancy in valuations of each industry. And there's really nowhere else to put money right now. This is the spot. Neil says, what do you like in terms of stocks? Yeah, don't make your life so hard, Neil. 500 stocks in one ETF, automatically rebalanced, easy to hedge. This is the spot to put your money. It's the SPY ETF or UPRO. Sean says, why are we in silver if it's a bad idea? It's a hedge, guys. We buy hedges to protect against the portfolio going the wrong direction. So we got to think, what would happen for things to go against us? Silver would go up, banks would go down. So if treasuries go lower, then that's going to be extremely bullish for silver and very bad for banks. So bottom line is If this collapses, banks crash first and silver goes up the most. And so that's why we have those hedges right now. Now, I will be more confident to exit those as soon as we see the TLT really selling off viciously. And so we'll react quickly to that and readjust where we hedge. And basically, I would hedge the technology companies instead of the banks if I did get more confirmation that interest rates would rise. Right now, the TLT is down 0.15% today. That's not enough to really confirm that this big move is about to take place.
And Jason, Neil also asked if we were going to keep the XLK put positions for the Pro portfolio.
Yes, we have no changes to the portfolio, and XLK.
That's oh yeah. So it would
XLF.
Yeah, XLF is the ETF, Neil, that we have for our hedge or our insurance.
The financials, yep. Okay, here's a look at that beautiful UPRO. And again, we're looking for potentially several $1 trillion to escape sovereign debt, precious metals, and rotate in the S&P 500. It's an easy 10 to 20% move from here. Could happen quickly. It could happen before the election. So that's potentially a 30 to 60% return on UPRO in the next 2 months, which is hard to believe when we have so many unemployed, but we're just looking at money flows. So I'm happy to sit there and lose a little bit on our downside protection while we watch this play out in the Pro strategy. Now, again, once we get interest rates to an attractive level and the old school bond stock risk parity strategies is intact, expect to get back into treasuries. In the long run, treasuries have to be suppressed lower over time. It's really just in the short term that it's quite easy to predict that the Fed is motivated to allow interest rates to rise. It helps them accomplish all their goals, again, while protecting the currency, the dollar. So expect to buy TMF probably right around the election if interest rates have risen towards 2%. I won't be buying treasuries until they have risen significantly. Same thing for UGL. We hit this one perfect. We caught the big run up, predicting that, again, the low interest rate bonds would be not attractive. And with inflation rising, money would flow into gold. And so now the Fed can crush that quite easily, again, by letting interest rates rise. But they can only do it for a very short period of time and to a very specific interest rate level. At that point, we'll be right back into precious metals as well as bonds. Now, are they going to let it rise rapidly in the next 2 months? Is this going to be slowly drawn out for 6 to 12 months? That's why you've got me to closely monitor that situation. Here's one of my favorite stocks. If you want a bonus pick, you're getting plenty of exposure to this with the S&P 500 with this prediction. But this is probably one of my favorite stocks, assuming we have a recovery, is Freeport McMoran. And so look at that beautiful run up in 2009. And again, I would expect this to repeat itself this year. Here is the Hong Kong dollar. This is the peg that's supposed to trade between 7.75, 7.85. And what's it doing? It's on the strong end of the band. What does that really tell you? It tells you Asian currencies are scared that they're going to lose purchasing power. So they're going into the Hong Kong dollar, which tracks the US dollar. They're trying to preserve their wealth. So this actually signals weakness in China and does create some warning signs for us that there are risks ahead. Now, this is interesting to see the Chinese currency strengthening against the dollar. We are ready to short the yuan, especially as we get past the election. If Trump wins the election, I'll most likely immediately put on that short position, expecting that we are going to do more tariffs against China because they've failed to make their trade deal. We're about to kill TikTok and WeChat, and we're cutting off all technology, all the semiconductor chips to Huawei. So those phones may be completely useless within the next 6 to 12 months. So we're headed to war with China without question if Trump wins. So in the boot camp, get excited. The time to short the Chinese yuan is not far now. Okay, we did look at interest rates, so we have not seen those pick up yet, although we are expecting them to. So to close out the prediction now, or the presentation now, we can review the news. But before I do that, let's go ahead and take a quick break and take questions. Tino says, what price do you think to add more shares of UPRO? Yeah, Tino, so I would just follow the trading plan at all times.
Yeah, and so Tina, if you're also looking to add more capital today, today is as good as day as any. And so if we have it up on the trading plan that you can get into those assets, you can always add more too. So if you wanted to get another tranche of 50K, Tino, you could certainly scale that in today. Okay, we're looking for a massive melt up in UPRO, really coming into the election and coming into the end of the year. So yeah, today would be as good as any, honestly. Okay.
And we just got over the 340 level, which was a huge mental block for investors. Was can we bust through that all-time high? So yeah, I would get invested.
Yep.
Now the biggest risk right now, I would argue, is no stimulus deal. That could put some pain on the recovery. So that's currently my biggest concern right now is no stimulus. It looks like Pelosi is willing to do a $1.5 trillion deal, which would be a huge injection of capital into the economy. And Trump is motivated to do whatever deal he can get the Republicans to agree to, because he knows free money equals more votes. So that's their biggest risk right now is no stimulus. Let's see, what other questions do we have out here before we jump into the news over the weekend?
And nice, Tino, very nice. Are you scaling up a couple tranches, or what does that look like for you, Tino? So I think Tino initially started with 50,000. And I know he said he was going to eventually probably scale in as he got comfortable. So we're just trying to see what that kind of looks like. And I know I had a couple people touch base last week saying they were scaling in kind of in tranches of a couple 100,000 people that were clients already that were increasing their exposure to make some serious money into the end of the year here. So very, very good on that, existing clients. Let's see here. What other questions do we have? And yeah, any questions that you have? And Neil, if you have any additional questions, you had some good questions coming through. Mukesh, if you have additional questions too, please feel free. Let's see here. Khalid. Let's see here. Who have we not gotten a question from in a while? Kathy C, are you all set up now with the new allocations? Let's see here. Let's see here. And Manny, first time we've seen you in here, Manny. So thank you for joining us here. Let's see here. Who else? Neil, first time seeing you here. Welcome in. Thank you for your time to join us. Please feel free to ask any additional questions that you do have. Great questions earlier as well. Okay, we have a RE. Not sure who you are, but please feel free to go ahead and ask any questions that you do have. Let's see here. And so we got one from Tino. He said, how about instead of buying put as a hedge against the SPY, or to buy inverse ETF to buy a worthless expiration, will that work too? Yeah, so Tino, if the market gets real skittish, we'll allocate to bonds. Okay, but yeah, the option contracts the way to get the insurance at the lowest cost. Okay, and sure, it will drag on that performance slightly, but we're still going to massively outperform the S&P 500 the way we're set up anyway. So it's really okay to have a little bit of a drag to put ourselves in a safer area. Okay, let's see here. And Mukesh says SPY put on 820. Let's see here. 820 expires with 821 contract. Yeah, no, Mukesh, that's an old video. So we're currently in the XLF puts that Jason has on the screen. So we're at the 918 XLF puts. Okay. No, you're good. You're good, Mukesh. Great question. Yeah, you're probably watching the video from a week or so ago. Okay. Um, but yeah, you're looking at the live presentation here, and then we'll post it into the webinar here, but you will have full access to the trailer here as well. Okay, so we'll post that into the chat box for you. You can always review the live there. Okay, and you can always see the recorded version of the webinar as well. All right, and let's see who else here. So great questions, guys. All right, awesome, Mukesh. And how much are you allocated on either on paper or real capital, Mukesh, at this point to test out? Are you using 100, couple hundred? What does that look like for you? Okay, Mukesh is going to start with 25. Very nice. Awesome, Mukesh. Let's see here. Okay, sounds good. Okay, yeah, awesome, Mukesh. Yep, and that's the minimum to get started. So that's great to know, bud. But nice way to use real capital, right? Just a small chunk. See how that performs. That way you can, literally test drive the car right before you buy it. Get in there, see how it performs. See its safety features, that type of stuff. Before you do purchase the car. Okay. And anyone that's on a trial, if you haven't yet, absolutely, folks, either allocate some real capital or use your paper trading account. Okay, that way you can see how much money you would have made, on a week basis, on a week-to-week basis, and really just over the life of how we make all the changes and such. Okay, let's see here. David said on the buy and hold portfolio. Let's see here. Why not go more into UPRO with the extra cash in the account? By the way,
Too risky without the puts, David. So that's why. If you want to be more leveraged, you need to follow the pro so we can use the put options. Put options are beautiful when volatility is low because you can go pay a tiny insurance cost. And if things just spiral out of control, we're actually going to make a huge if the banking sector crashed and the S&P 500 went down, we could actually walk away with a massive profit, even though we're long the SPY with 3 times leverage, because I have a huge put option position in banks. So it's a beautiful setup. Really, the pro will greatly outperform buy and hold when there's extreme volatility. And when you realize this economy is really being stitched together with printing money, and we have a long ways to recover, then you'll start to understand why, number one, I'm going to use the 3 times leverage because central banks don't print money except for about once every decade. And they only do it for about a year or two at a time. So this is the greatest opportunity probably in the next decade to make money if you do it the right way. And so I say, use the leverage, take advantage of this once in a decade opportunity, but do it safely with a large put option position, protecting the riskiest part of the economy. And so tech companies are doing great. Banks are not. The greatest return is going to be rewarded investing in the riskiest sector. So that's why we're hedging that part of the S&P 500. Okay, David says that UPRO has gone up $10 since we started recommending it. Very good.
Just getting started.
Silver is basically a supercharged lightning rod treasury right now. Treasuries just suck. We really would have to collapse the whole economy for treasury investment to make sense right now, which could happen. If Joe Biden wins, I'm not joking, he's literally telling us he wants to collapse the economy to save lives. I mean, I'm not making this up. He literally tells us this every day now. So their plan is to, and you can see Google's making the same plans. They canceled work for a year before there's any data to even support that. So this is an orchestrated attack against the U.S. It looks like they've overplayed their hand. I'm expecting that all this nonsense comes to an end in November and we get a nice recovery. There's going to be volatility. You're going to have to follow the money flows. You're going to have to be smart. We're going to help you navigate those waters. So yeah, everything's done very specifically. I wouldn't recommend trying to get clever and change anything. So a lot of thought is put into how we play this market. And again, sometimes we're going to look like we're too defensive, but then all of a sudden that insurance policy returns 1,000, 2,000, 3,000%, and you've got a 2% position in it, and you make 20 to 30% overnight. So you got to realize we are in a very risky time period here and a very unique opportunity to make money because of this high risk. So if you're an idiot, you're just going to go super long whatever's moving up the fastest and have no downside protection. If you're like us, you're going to still try to get the biggest return, but you're going to try to do it with the most safety. You're going to do that by buying hedges against the riskiest parts of the market. So silver acts as a supercharged treasury right now. If treasury yields crash, then I'd expect silver to outperform the TLT probably 5-1, maybe even more. So that's your put option in the buy and hold is silver.
Yeah, exactly. And we're always going to have risk management built in, literally designed, so you all can just replicate that with your own capital. Okay. But yeah, we're always going to have some type of risk management built into what we're doing and why, right? Always thinking about Buffett's number 1 and number 2 rules. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Okay. So we're, unlike probably literally every other advisory service on the planet, we are going to build in risk metrics, right, and risk management into every single thing that we do. Okay. Yes, Julio, great question. He said if we want to add in another 10,000 into the buy and hold, will be the same ratio as 10 UPRO and 5 SLV.
That's correct.
Yep. Nice question, Julio. Yep, and it's good to go now to allocate to it.
And the reason why we're so defensive is because of our clients' time horizon. If you are a youngster, you can swallow some volatility in your retirement holdings. But if you're going into the last several decades of your life, you can't afford to lose a lot. So that's why we're so defensive. Our clientele are almost completely over 55. Most of you are already retired, so you don't have new sources of income. So you want to get the best return with your capital, but you want to do it safely. So that's the name of the game with Portfolio Builder. Any other questions before we jump into the news? And just from some background, we came into this selling other gurus for the last decade, and they're all trying to outperform everything and get rich quick. And what do they all do? They end up taking too much risk and blowing out accounts. So it's just a recipe for disaster. After a decade of being in this, we've found that the turtle strategy is the best. Let's finish the race. Let's do it at a consistent pace. Let's not be that rabbit that burns out, that overheats and crashes. Okay, so this is huge. TikTok is fighting Trump. This is the fastest growing phone app in the world. It's extremely competitive against Facebook. It does look like Facebook is one of the few technology companies that is breaking paths with sort of the ringleader, which is Microsoft, Google, and Amazon, as well as Twitter's kind of their little sidekick. But Facebook's been clearly trying to deviate from policy that those folks are doing. And it looks like the White House is rewarding their help. And one way to do that is kill their biggest competitor. And what's so different for Facebook compared to all the other tech conglomerates? Well, their business model is involving communication between billions of people. And China will not allow that business into China, period. They have extreme censorship. In fact, they have about 1 million people who sit there and read the conversations of the entire population. They have keyword lists. It's not that you'll get posts taken down. It's more like they are predicting what you will say before you say it, and they're automatically deleting it So it's just remarkable. There's people who sit there and spy on the Chinese to see what are they censoring. It's absolutely insane. So the Facebook interests do not line up with those of Google and Microsoft, who are trying to partner with China. They want to create the first real artificial intelligence, and China is leading the path for that. They have the most data, and so this is just going to get uglier and uglier. Trump is trying to force TikTok to sell to either Microsoft or Oracle or Twitter, and that's going to really piss off the Chinese, because this is one of their fastest growing companies in the world, and this would absolutely decimate it. So it looks like he's not going to pull the trigger on that until after the election, but that is a key risk. The long view says, I don't think we get another stimulus bill before the election. Democrats have no reason to cooperate. Well, they do have reason to cooperate, because Trump's going to sit there and say, look, I want to send you $3,600, but the Democrats won't do it. So that's not going to go over well. But we'll see. I also believe they're going to run out of cash at the end of September. So we're keeping a close eye on this. This remains probably the single most important topic right now, is passing another stimulus deal, because we haven't reopened the economy. The governors are refusing to do this. We're not opening up the schools. We're not allowing people to go back to normalcy. So we have to keep stimulating the economy until we get there. What we have learned so far: the U.S. consumer spending is improving. The U.S. labor market is on the road to recovery. Yield curve control is off the table for now, as we predicted before the FOMC minutes, which is why we got you out of gold before it's started this big sell-off. And the Fed doesn't intend to be more dovish at this point. Once again, we predicted all of this. A lot of people were predicting the opposite, that the Fed will aggressively ramp up QE right now and start QE yield curve control sooner than later. Okay, Soful Pin says she's up 2% from Friday, I believe. Way to go. Very good. This is backfiring on the Democrats, I believe, which is Black Lives Matter. It started off as a beautiful protest against a egregious crime, which we're all aware of, but then it's been turned into complete anarchy and terrorism. And so it's getting worse and worse. And these governors are refusing to do anything about it. So it's just absolutely insane. So great way to piss off a whole bunch of people. And I'm starting to think it's going to be a landslide this election. We'll see. Now we've got some photos of this guy's got AK-47 and he's pointing it at the sheriff. Complete chaos. And again, the governors won't react. They will not react. They're just allowing this behavior to occur. So I think this is backfiring on them. Joe Biden, President Obama, and I established a White House office to prepare our nation for pandemics. Donald Trump eliminated it, and we've been paying the price every single day. That's complete garbage. So there's over half of the U.S. deaths are due to 5 governors sending sick elderly into nursing homes who are positive. Over half of the total deaths of the coronavirus were from 5 Democratic governors who pushed sick coronavirus patients out of the hospital into nursing homes. Now, this is interesting. Trump is just desperate to get past this pandemic, whether it's a vaccine, hydroxychloroquine, plasma treatment. You can tell he just doesn't care. He just wants to get this economy rolling again, as do the banks. The banks really need everybody to get rolling here so they can start paying their mortgages. Peter Schiff, Joe Biden claims that he doesn't want to divide people, but that's precisely what he does. Joe Biden doesn't see people as individuals, but as members of groups to which he wants to grant special privileges in exchange for their vote. If elected, he will be the divider in chief. Carl Quintanilla, Amazon is adding 2,000 corporate jobs, Facebook leasing an additional 700,000 square feet. But remember, those are only tech companies. Tiffany renovating its Fifth Avenue flagship. New York is dead. So there's a big article we read for boot campers. The verdict is still out on that. If we don't reopen New York and get rid of all these policies, then it could collapse. But I think people are getting completely pissed off here. So I do think we're going to see everything reopen as we get past the election. China dropped a virus bombshell over the weekend. Health officials said they're already inoculating high-risk members of the public with a trial COVID-19 vaccine for a month now. The global vaccine race is atypical in so many ways. So usually with a vaccine, what you want to do is give it to a small group of people and then wait a year and see what happens when they get the same disease a year later and see if they have a bad reaction. So this Operation Warp Speed and trying to go force 7 billion people to have a vaccine is not something I'm a fan of. And I'm not happy that Trump is pushing that either. But we're keeping a close eye on it. Now, the vaccine is what some very, very powerful people think about it. Who's the number one lobbyist of the government every year? It's the drug companies, 300 million a year minimum. And so they're just not going to stop terrorizing the United States until they can sell these vaccines. That seems to be the case. So we'll see how that all plays out here. Now here's a lady. Look how people have been just completely brain dead over this, dragging this person out by her feet because she's not wearing a mask. Imagine what they're going to do if you don't take the vaccine come up in a few months. Jim Bianco, if true, this could be a big deal. So first we had a false alarm that he was dead. Then he came back to life. Now they're saying he's in a coma and his sister is taking control. Now, as far as I know, she's pretty cutthroat. So this could be a political risk. Gary Barber says the Eagle has landed. Oh, very good. Glad it arrived, Gary. Michael Levitt, I just saw this. These data are encouraging as 64% of COVID-19 deaths are over 85. Get that. 64% of the reported deaths are over 85. So you got some fellow who was on his deathbed in hospice and was going to die naturally, and the virus tips him over the edge. So they report that as a COVID-19 death. So that's really crazy. Over 64% of the deaths are over 85 years old. This is just shocking. So looking at the different generations, how many vaccines you have to take, 2 to 7 to 14. Now we're giving kids 69 shots by the time they turn 18. Absolutely incredible. Sorry for the dizziness. Let me get back to where we were. Multiple businesses set aflame by BLM riders in Wisconsin. Just terrible. Here's a car lot burned down by BLM. Now, the World Economic Forum has been openly discussing how to take advantage of this pandemic and reshape the world. And so they've got a whole bunch of plans for us that no one's going to like. I won't play this clip, but if you want to watch it, essentially they want to collapse middle class and get carbon emissions to zero. I mean, that's really at the bottom line, is reduce the population growth because they believe it's unsustainable, and to get carbon emissions down to zero, to tax essentially anything that breathes or creates carbon. Tom Sharp says there's still some 85-year-olds who can still snow. Tom beat the coronavirus as well. So it's just, now here is a chart of traffic congestion. So more traffic congestion shows more recovery, and we're nowhere near where we were at pre-crisis, but we are seeing a recovery. Now that recovery was starting to crash as we had that second wave hit, but that second wave is dying down rapidly, and we're starting to see another recovery of, what's funny to call it a recovery of traffic congestion. Restaurants are doing really well. In fact, Dean and I were trying to go to dinner this weekend and we couldn't find anywhere. It was all booked out. And so that's very good, obviously, but there is reduced capacity at these restaurants. So they'll be lucky to survive if governors don't start to get rid of all these rules. They have to eat outside with 25% capacity. And but that again is signaling recovery ahead. Now look how silly this is. Let's wear a mask and put a slit in it. What is, why would you do that? Just insane. During the Democratic presidential candidate Joe Biden's vice presidential tenure, his 26-year-old niece coordinated the Obama administration's China approach as a special assistant to the Treasury Department. And guess where she came from? The Bill Gates Foundation. Now the Canadians went to end the lockdowns and stop masks, so we're seeing people protest everywhere. Look, we had good reason to be scared in March, but the data just broke down. We had millions of cases rising at the expected rate, but the hospital load and the death count just didn't align. And so bottom line is the folks who were on the verge of death died, and now everyone else can beat it naturally. So why on earth would we go create some mandatory vaccine when 99.95% of us can beat it naturally? It makes no sense. This is a great summary of the World Economic Forum discussion, which has gone viral. I love Nancy Morgan. She's, I would say, very good at finding the top headlines. She is happy to critique Trump and Biden and anyone else. Does a great job summarizing that several-hour video that they put out about the Great Reset. So good video to watch, 10 minutes long. Now this is a problem. The reason why our recession was so short-lived was because spending has been rocketing because of all this stimulus. So without the new stimulus deal, the data points could start to look bad. Now, probably not by the time the election happens, but that could be very influential on the vote. People need some new cash injected as soon as possible. So I do think that is very critical to get that stimulus deal passed. Now, this was interesting. The president, I haven't been following this too closely, but the president of Belarus has claimed that the World Bank would only give their government a loan if they did extreme lockdowns. And so he's worried he's under attack. We've got millions of people protesting. I haven't followed the details of that, but we can see it's been a coordinated effort to create this lockdown and try to crush the economy. This was all planned. Exposed, World Bank coronavirus aid comes with conditions for imposing extreme lockdowns, reveals Belarus president. Longview, why are people arguing about the mail? USPS delivered 500 million units a day last year. There were only 23 million ballots in 2016. So that's what the whole stimulus is being held up, is about how much money is going to go to the post office, and more importantly about the mail-in voting. Ice Cube says, where's our bleeping bailout? Slams the Democrats for abandoning blacks. Talks about how they bailed out all their buddies with $3.5 trillion. Black businesses didn't get the cash. Good points. He has great points. They talk all this hype, but don't deliver the goods. Twitter places public interest disclaimer on US President Trump's tweets on mail drop boxes. So wait till after the election. All of these big tech giants are moderating content, which they're not allowed to do. The whole reason they can get away with their platform is because they specifically do not moderate content, which essentially has special laws that make them not liable for what people say. So if they want to start moderating content, that legal protection's gone and their whole business model is destroyed. So perhaps there is some substantial risk to the tech companies after the election from what they've been doing. Tom Sharp says, more very recent YouTube discussion, very interesting, substantial agreement with your thinking. Tom's an excellent studier. He sends me a lot of great content. We're having a civil war. We can't go after China, who I would argue is instigating this with a handful of super elite, until we fix our problems at home. So we're in the middle of a civil war. Daniel Levitt, if this doesn't indicate that COVID is over in the UK, then I don't know what does. The media should be reporting this and be upbeat that everyone should get ready to return. So you can see no cases in the UK. But they're not releasing all the lockdowns. Why? China, domestic new confirmed COVID-19 cases dropped to 0 in China again. So what has China been doing? They're laughing at us. They tricked everyone. This was all a big plan. So they're taking videos and spreading it all over the world of them having huge rave parties with no mask, no social distancing in Wuhan. US immigration levels haven't changed. That's funny. I thought Trump was the racist who's not letting immigrants in. More riots. Now, here's something showing that all these extreme lockdowns don't work. The second you try to reopen, cases come right back. Specifically, South Korea, Japan, New Zealand, Australia, they did some pretty strict lockdowns. Everybody was saying, bravo, way to go. But now the cases are coming. The bottom line is everyone's going to catch it, and that's that. There's no way of getting around it. And the good news is it's not as dangerous as we thought. Now we've got BLM going through residential areas, just completely insane. This is going to piss off a lot of people. Okay, and we'll end here with this comment. These riots are an anti-government movement from the left that are all in Democrat-run cities. The mayors have got to let their police do what they know how to do. It would be very easy to suppress or call in the federal government. We will solve the problem fast. So I think that's the bottom line. People are getting pissed. This is going to be probably a wild election. Who knows what other surprises are coming down the pipeline here. That's why we've got the put options. That's why we're looking at where the money's going to flow and take advantage of this very unique situation. Okay, very good, Dean. Go ahead and take it away.
All right. Thank you, Jason. Appreciate it. And give me just a couple seconds here and we'll get all that set up. All right. Any additional questions here, folks? Paid clients, before we switch over to closing out with the trials here. Any other questions at all? Yeah, and portfolios are looking good from last week to this week. Okay. And John says, am I saying this correctly? Our current posture in the S&P 500 because treasury prices are rising and rates falling. Metals should also fall as a result. Therefore, money is flocking into the only safe haven there is at this moment. Question mark.
No, interest rates are rising. But after that, you got it right.
Yeah.
So if I'll go ahead.
I was just say kind of the 10,000 foot overview, John, just to kind of make things really easy to look at. Trillions of dollars in Exodus and Safe Haven. It's all going to go somewhere. Okay. The S&P 500 is going to be the recipient with record levels of quantitative easing. I think that's really the easiest way to kind of break it down. Mukesh says, great high level of understandings of marketing and strategy. Hey, thanks, Mukesh. Appreciate it, bud. And thanks for the conversation Friday, too. That was really fun. Okay. And John Nolan says, okay, so perfect. I think and any other additional questions. And if you want, guys, go ahead and just raise your hand. And then you can ask those questions live directly with Jason as well. That's the best way to get any type of questions asked. You get that live interaction. It's really neat. And we love to dedicate our time to answering your questions and helping you with that educational aspect of what we deliver. Okay. Very cool. And so give me a second here, guys. I'm going to go ahead and transition over screens here, and then we'll close out the webinar here. Okay. Looks good. Okay, guys. And so one more time, just a quick check-in here on results. It looks like it's kind of where we were when we started up the portfolio. So this is 45 days into this new portfolio allocation. It's showing a profits just shy of 64,000. Let's see here, it's $63,931 here, and that was built in the last 45 trading days. Okay, and then from Friday to today, nice increase in the portfolio, just shy of $13,000 at $12,966.72. Okay, and that was the portfolio movement from Friday until today. So really nice job there, Jason. We gained basically 1% over basically 1.2%. So the easy breakdown over the weekend with protection. Okay, and if you take a look at let's take a look here and let's just see what the S&P 500 did. Okay, to kind of gauge those results. Okay, so we can take a look at the SPY. Okay, the SPY is only at 0.74%. So we're massively outperforming the SPY with protection. Okay, because our jump over the weekend was about 1.2%. In the SPY, it's only 0.74% here. Okay, so pretty cool to see that we are massively outperforming the S&P 500. Okay, really at a ratio almost 50% more outperformance just from last trading day on Friday to today. Okay, but we have that underlying put protection. Okay,
and what really makes us happy is when we see our positioning outperforming tech now, which I think is going to catch a lot of people off guard because they're all just piled into the tech companies, and I think we're going to really outperform that group right now.
Yep, awesome. Very nice, Jason. Very nice. Okay, guys. And so really quick, anyone that is on a trial, if you don't have my number, please feel free to save it. It's in the purple here towards the right-hand portion of your screen. It's 505-322-7515. Okay. And so Sofel, great job, bud. I think Sofel made about $500 from allocating last Friday after we spoke until today. So awesome, Sofel. Proud of you, bud. Let's see here. Who else made some money over the weekend? I know all of our paid clients did, but is there any people that are new on trial with us that allocated last week and have seen some pretty kind of no matter what day you came in last week from there to today, you should see a pretty serious benefit to your account at this point. Okay. All right, let's see here. All right, any questions out there? Let's see here. So Darlene Bennett, David, let's see here, Harriet, James Robertson, any questions from you all? I know you all aren't clients here, so I'm just going to call out the people I don't recognize here. Let's see here. Geronimo Medina, any questions from you, bud? Jeremy, any questions? Let's see here. We also have in Khalid. Hey, Khalid. Great conversation Friday. Good to see you back here. Or Khalid, actually, we talked last Tuesday, actually, I think it was. And let's see here. We have in also Robert O'Connor. Hey, Robert, one of our newer pro members. Robert started with us last week. So let's see here. And Robert, have you scaled up your allocation at this point yet? And did you get that options approval with Schwab? And I think Robert put together about 100K last week to put behind us. And I think he should be up 2 or 3%. And I know he also made about $7,000 on his trial. So we should have made Robert probably right around $10,000 in a week or two here. So not bad. Let's see here. Ron Brooks. Let's see here. Sadish out in LA. Hey, Sadish. Hope all's well, bud. Let's see here. We have Tom out in the Bay Area, still skiing at 85 years old, 85 plus. I love it, Tom. Okay. And Soful, excellent job, bud. I think you should be kind of sitting around somewhere around a $500 profit. Okay. Um, okay, cool. And it looks like we got through that. Oh, and Tino, how much additional capital were you going to allocate? Were you going to go another 25,000 or a couple other tranches of another 25,000? What did that look like for you? Okay. All right, guys, looks like we don't have any questions as of yet, but just feel free to go ahead and raise your hand, ask any questions you may have. All right. So now I'm going to go ahead and transition over to my presentation here. And we're basically going to help you guys kind of understand how we help clients generate profits in the safest manner possible. Okay. So let me go ahead and clean up my annotations really quick, and then we will finish out the presentation here. And thank you all for your time and attention. I do appreciate it. Okay. Okay, guys. So real quick, if you have not yet, please feel free to save my number if you're on a trial. Okay, it's 505-322-7515. And if you are on a trial, feel free to just send me a text and say, hey, Dean, I was in the webinar here today. Okay, that way I know who you are, because we do have quite a few people that are on their one-time trial. Okay, so please feel free to go ahead and send me a text. That way I know who you are. Existing clients, if you have any questions, you need some content, need some help getting to the content, just give Victor a call, 505-203-0396. And if you are going to get started today, just save Victor's number now so you do have it in your phone. All right. So real quick, guys, we kind of focused on everything we were going to do today. Okay. And really, guys, this part of the webinar is dedicated to you all for any and all questions you have. Okay. And just jump in there at any point, guys. If you're on a trial, you have a question, just jump in. We'd love to help you with that question. So welcome and thank you for taking the time to enjoy the investment webinar today. Hope you all enjoyed the education, and please, guys, don't be shy. Just ask any questions you have along the way. We truly appreciate your time and attention to show you how boring successful trading can actually be when you have the right strategy. Okay. So meet the portfolio builder team. Well, who are these guys you just heard from, for an hour and a half? Okay. Well, the voice you hear now is Dean. Okay, that's my name. I'm an investment consultant and partner. What I do is have conversations with all of our clients that are looking at our service through our freemium one-time trial. Okay, they're kind of taking a look, seeing how things work, why they work. Okay, I'm going to be your dedicated resource, folks, for any and all questions you have during your trial. Okay, and you actually have your own concierge as well. I lead a team of investment consultants that are your dedicated concierge. But when you guys have any questions at all, and it's not during the live webinar time, just call me or text me, and we'll walk through those questions. Okay. If you're an existing member, as you know, Jason's always going to be your resource for any questions you do have. And depending on the level of service that you have with us, you'll have from 2 to about 10 hours a week with Jason to ask questions with him live. Okay. So paid members, Jason is your dedicated resource for any and all questions. Okay, so real quick, folks, want to cover our missions that we have with what we do with our hard work to help you. Okay, with the investment world. Okay, number one, engineer and build the safest growth for your hard-earned nest egg. Number two, educate you on how the central bank controls the market and attach your capital to it. Okay, number three, answer any and all questions you have about our portfolios in live interactions in our exclusive webinars. Okay, so it's a couple really cool things, folks, that you're going to get from us that you're not going to get from financial advisors. Okay, engineering and building the portfolio. Okay, really is something that money managers don't really look at. It's crazy, but the typical investment advisor tells you to dollar cost average, buy, hold forever. Right? They don't know how to make money in down markets. That creates an incredible amount of high risk. Okay. And that's something I've had to experience, unfortunately, personally, with my grandmother right before she passed away. but something you can absolutely avoid by understanding risk parity and how to make money in down markets. So really a number one, engineer and build the safest growth for your hard-earned nest egg. How we're going to be different is really just not telling you to net long buy stocks all the time. We're going to show you how to make money in all market conditions. Okay. Number two, we're going to educate you on why everything, right? 100% of our thought process, why we do it. Okay. That's why you guys saw a bunch of great questions coming through. Those are a lot of our clients and some of the people on trial trying to understand why we think the way we do. Right. And it's really cool, folks, because you're going to get that education. Okay. And that's going to be something you're going to be able to pass down to your kids and your grandkids. Because the education aspect doesn't leave, right? Once you have that, that's a value you can use forever. Okay, number three, answer any and all questions you have about our portfolios and positions and live interaction in our exclusive webinars. All right. So many of our members make the cost of our membership or more in a few weeks, and our trading plan takes less than 2 minutes to execute at noon Eastern on Monday, Wednesday, and Friday. Okay. My challenge to you is to see how much you can make over the trial. And I want to ask you, is there a better way to build trust? Okay. I haven't found one, but if you do think of a way to develop some trust together, please feel free to shoot me a text with your, with your information. I'd love to take a look at it. Okay, we're going to follow two really simple rules, folks, when it comes to investing. Rule number one, never lose money. Rule number two, don't forget rule number one. Okay. And folks, the whole point of the webinars is to help you quickly establish a defensive balance for your portfolio. Plus, you'll be ready to profit from a very risky time period with our trade engineering. Okay. Trade alerts will be delivered at noon Eastern, just as they were today, via email and text message. Okay. And if we make any changes to those portfolio, folks, it will come out Mondays, Wednesdays, and Friday, and we will host our live presentation at noon. So we engineer our positioning in coordination with the financial system and macro environment. All you have to do is take 1 to 2 minutes to replicate the trade in your account. It's super simple. Okay. You can always review our track record by going to portfoliobuilder.io/track-record. We build trust with our clients by being 100% transparent with every position we've ever had. You can always access our track record by going to portfoliobuilder.io/track-record. Okay. Now, there's going to be a few things that you guys are going to need to have in place to get the most out of your trial. Number one, you're going to need a brokerage account set up to follow our trading plan. Okay. If you're going to use the pro portfolio, you must have options trading enabled. If you're not going to use a pro portfolio, that's okay. You won't need the option trading enabled. All right. But then you can use real capital or simply paper trade. Then you can see how incredibly easy it is to give your hard earned money the protection it deserves. Okay. Number two, you're going to need the ability to follow our trade alerts released at 12 Eastern. These alerts are by no means time sensitive at all. They simply need to be placed before the market closes at 4 Eastern. So if you're doing the pro portfolio, folks, you're going to have a 4-hour time window to enter your trades every Monday, Wednesday, and Friday. Okay. And if you're doing the buy and hold, there's actually a 24-hour replication time window. Okay. So you don't have to be sitting there glued to your desk. When the alerts come out, if it's a few hours later, it won't matter. And I've put in my trades, folks. The second they came out, I've put them in 5 minutes before the market closes. Just kind of in the middle while I'm between calls. Okay, and I have noticed absolutely no difference that if I put it in immediately or if I put it in, literally 5 minutes before the market closes each day. Okay. So pretty cool. And what a lot of our clients do is they actually will set some time in their calendar so they know every Monday, Wednesday, and Friday if they are trading when that trade will take place. So pretty cool. So number three, you're going to need a mobile phone to receive our text message trade alerts. Okay. Many of our clients take these trades on the go from the airport, the restaurant, and the car, anywhere you have service. Okay, it's important to make sure you entered your cell phone number when you sign up for the trial. If you use a landline, email the cell phone number to ryan@portfoliobuilder.io or simply type in your full name, cell phone number, and email to the chat box, and Ryan will add you to the system. Okay, last but not least, you will need an email provider that is in good working order. We do send out quite a few bits of content there via email. All right. Hey Tino, thank you, bud. I appreciate it. And Tino, how much capital were you scaling into? We're going to do another 25 or a couple tranches of 25,000. What did that look like for you, Tino? Oh, cool. And Tino was just saying he's out. Thanks, guys. Awesome, Tino. Appreciate your time to join us here, bud. All right, guys. So you can see how we smooth out the wave and avoid big drops with our positions and risk management, right? So in December of 2018, the SPY fell, pretty big drop, 16.63%, but we made 1.17%. All right, we had a nice allocation to bonds that helped save us. In metals, that pushed up. We still generated profit when the rest of the United States was pissed off with probably at least a minimum 16% drawdown in their portfolio. Okay. Now in February and March this year, the SPY fell up to 34%. But what we did with the pro portfolio and the boot camp trades is make 9.2%. So it's kind of a neat comparison, right? So let's just say you had $1 million, $1 million portfolio in the market. You went through February, March, your drawdown is 340K. Okay. Otherwise, if our clients with $1 million portfolios actually increase their growth by about 92,000 in that same time period. So pretty cool. So here's in closure, here's the nuts and bolts of it. We're going to show you how to be defensive, balanced, and profitable in this market condition. Okay, Jason, our Chief Investment Officer, will be covering the build out of this portfolio today and each day, Monday, Wednesday, and Friday, live at noon. Okay, so pretty cool, guys. Just wanted to tap on that for just a second. And we'll cover a couple more slides and just see if there is any questions at all before we go ahead and do close out here. Okay. And please feel free to raise your hand, folks, if you guys want to chat live or just type them into the chat box. All right. So just one more time, guys, just want to reiterate, my name is Dean Gallagher. I'm literally your dedicated resource for any and all investors on your one-time free trial. Okay. So make sure to save this number, guys, if you haven't yet. Okay. And seriously, call me or text me with any questions you have, 505-322-7515. Okay. We love to talk markets and show people why we're using strict risk management in our design and approach. And the market's pretty cool. Sofal and I talked for about an hour last week. He did allocate to the portfolio at the time, and it looks like he's made about $500 from our hour conversation allocating from Friday until today. So love those conversations, guys. Look forward to that conversation with you. Okay. Let's see here. Let's go to the next one. So we love to sleep like babies at night, knowing we're using risk management to protect our hard-earned nest egg. Okay. Proper risk management provides consistency and reduces stress when it comes to investing. Okay. And I love the reduction of stress, guys. That's been so nice for me. Okay. Now let's take a look at one of the best performing ETFs that you can own today. Okay. So right now, folks, we own the S&P 500 with a free leverage ratio of 3-to-1. Okay. Without paying for margin or loans. Right. So if I wanted to go use some margin with TD today, they're going to charge me 7.2 points a year, right, annualized. I can own a specific ETF that we're about to take a look under the hood of. Okay, own that instead of that, and literally avoid 100% of margin costs or loan costs. Okay, but it's still going to leverage our money 3x. Right, so it's a really nice way to get a beautiful diversified exposure. Okay, in the S&P 500, but add some leverage to it because the Fed is printing this market into new all-time highs. Okay. So let's take a look under the hood of UPRO. That is the asset we own specifically. Okay. Today to see why it outperforms the market in a huge way. Okay. So here are the core asset classes. Basically everything you're going to see up on here is S&P 500 index swap. Okay. And what they use these for, folks, is to create massive liquidity. Okay. And then they also have exposure to the U.S. Treasury market as well to create extra liquidity as well. So really, this is just the S&P 500, and this is a way to and you can see quite a bit of capital, right? 883,000 or 833 million bucks in here, right? And there's quite a bit across this. And then also some allocation to treasury bills to really get the product ultra liquid. That way it has super tight bid and ask spreads, and everything I've seen on UPRO over the past kind of 2 to 3 weeks or so since we've looked at owning it has been kind of a 1 cent spread. So it's just part of how they create that liquidity for us. Okay. Now, what are the core stocks, right? When we take a look at this, well, it's all the best companies in America. And in my opinion, what you're looking at right here is, the top 20 best companies on the planet, period. Okay. Largest exposures to Apple. We also have Microsoft's next, Amazon behind that, Google behind that, or Facebook, I'm sorry, behind that. Both Google A class and C class shares behind that. Warren Buffett with Berkshire Hathaway behind that. Johnson & Johnson, Visa, Procter & Gamble, Home Depot, NVIDIA, MasterCard, United Health, JP Morgan, Verizon, PayPal, Disney, Adobe, Netflix, Pfizer, Merck, AT&T, Intel, Comcast, Bank of America, PepsiCo, Salesforce, Walmart, Coca-Cola. Okay. Literally, folks, just all incredible companies. And it's really cool. You don't have to go check on, all these 500 companies at all points, read all of their quarterly filings, nor have the individual business risks you can have by just owning a single stock. You actually have 500 of the best companies all bundled into this asset class. Okay. Now, what does the performance of UPRO look like? Okay. And does anyone in here know the performance of the S&P 500 off the top of their head since its existence, I should say? Okay. And does anyone know the general performance of the U.S. equity market actually over its 92 years? Okay. So long story short, guys, the general market performance for equities is about 10.3%, and that number has been massively ramped up over the past 20 years. Okay, that kind of used to be in the 7 percentile. Okay, it's now kind of in the tens because we've ran so hard because we started quantitative easing back in 09. That's a huge part of the reason why we are where we are today. Okay, and guess what? We have more quantitative easing in today. All right. So let's take a look at the inception of UPRO. Okay, so since its inception, it's averaged 33.18%. Okay, more than by 3 times outperforming the S&P 500 in the same time. Okay, now that's great, right? But we want to protect that asset with either protective puts, married puts, okay, or with the buy and hold, you simply have allocation to a safe haven, okay, and you generate your risk management by owning silver, okay. So we do this work and watch the markets 18 hours a day, 5 days a week, so you don't have to, right? So it's pretty cool, guys. Literally, we're doing all the hard work. You're going to have to do the work to replicate our hard work in your account. Okay, to enter position, it's 4 clicks. Okay, of either your desktop or 4 taps of your cell phone to enter a position, and then it's going to be 3 clicks or 3 taps to exit those positions as well. Okay, so that's how we're going to show you guys not only how to make some money, right, but do it the smartest way possible. Always have some risk management built in. Okay, to what we're doing at all times. Okay. So understanding our portfolio options. We do have the buy and hold portfolio, guys, and it's great for accounts $50,000 or smaller. Okay, this portfolio uses ETFs to be long or short specific asset classes. Okay, and it's really pretty simple, guys. Minimal changes were needed to the portfolio throughout 2019. We only made 5. So far in 2019 or 2020, we've made 7 changes. Had a lot more volatility, right? A lot of rapidly changing situations in 2020. I think really, in the United States and globally, we've probably had more changes this year than we've had in, I don't know, probably the last decade at least put together. And so that's been interesting to navigate, right? Finally, though, it's starting to feel a little bit like back to normal, at least within my family. So that's good. The only difference is my son is not in school yet. And really worried about the education systems for people in really middle school and elementary school especially. It's just it's crazy to have schools closed. There's too many things that are so important for them to be formed at a young age that they're not getting the support from now. So, but hey, it is what it is, and we move on, we adapt, right, and do our best. So no options were used, guys, and it did return 25.31%. Okay, so for every 100,000, you make a little over 25,000, and instead of having 7% drawdown months in the S&P 500, the biggest drawdown month for buy and hold was actually 1.6%. Last year, which is incredible. So a fraction of the drawdown is always going to be a goal of ours, guys. Better risk management, right, than just being net long assets. Okay, and the ability to also to outperform the markets, which is absolutely going on. Okay, so pretty cool. And just remember, folks, all the memberships are tax deductible for the year in which the purchase is made. Okay, so make sure to save your receipts, guys. That way you can turn it into your CPA at the end of the year. Okay, and use that as a tax write-off. One thing that's cool too, advisor fees can't be written off. Consulting fees, financial consultant fees can be used as a write-off. That's what our company qualifies as. So make sure you save your receipt when you do sign up today. Okay, very cool. And let's see here. Any questions? Let's see here. Harriet, David. Let's see here. Soful. Tino G, any other questions, guys? Okay, looks like we are good to go. So the Pro portfolio is very attractive to investors with over $100,000 to work with. Okay, this portfolio will show you how to trade like the top hedge fund managers without the 20% performance fees and 2% management fees. Okay, per $1 million, guys. If that fund makes you 20%, you're going to pay them $60,000 in fees between your 2% management, right? Is 20,000. And if the hedge fund made you 20% on $1 million, they're going to take 20% of that performance as a fee, which, obviously quick math on that, right? 20% of $200,000 profit is going to be $40,000. Okay. So between your management and your performance fees, are going to take 60K. Okay. Our cost of the Pro portfolios is absolutely a fraction of that. And you can actually get our help for the rest of your life at literally a fraction of what the hedge fund is going to charge you. Okay, so changes are going to be made on a weekly basis to ensure maximum protection of your capital. You have 6 to 8 hours of live education and training each week. Okay, you can have a sophisticated balance of core asset classes. You simply buy the ETFs, however. Okay, and Pro members really enjoy the exclusive content produced in the Wednesday and Friday webinars. Okay, yes, Julio, great question. Yep, Julio said, are the sign-up fees deductible even if you don't open an LLC or company? Absolutely. Under membership fees and dues is where you can expense it as an individual investor. Okay, very cool. And let's see here, guys. Your Pro training is going to be every Monday, Wednesday, and Fridays at noon Eastern, like clockwork. Okay, and once again, all memberships are tax deductible. All right, folks, and I think that pretty much sums up what we're doing. Okay, and just wanted to touch on this, guys. The buy and hold membership, the price is going to go up this Friday. Okay, so the price is actually going to go up 100% from where it is today. So if you're thinking about signing for buy and hold, signing up for buy and hold, make sure to do that before the price does increase. And as all of our existing clients know, we're not joking when we say we're going to increase our prices. They've all seen us do that over the years as we continue to grow in popularity and expand our client base. Okay, so this portfolio will double in price, so make sure to get signed up with that today. Okay, now the Pro portfolio, guys. Once again, this is if you have over 100K, that's a good place to be looking. If you have less than 50K, buy and hold is where you want to be. Okay, now we also have our boot camp. Okay, so it's pretty neat, guys, because we're actually going to teach you a little bit more of what we know, what we understand, okay, and neat exotic trades that we see come across our desk here will be alerted through the boot camp. Okay, now the time's a little bit different on the boot camp, so that's going to be Thursday at 3. Okay, and just remember that is tax deductible as well. Now we also have the Ultimate Lifetime Membership. Okay, and that's also going to get you an exclusive webinar that's going to be Tuesdays at 3 Eastern. So you're also going to have select trades geared to elite traders and only available to lifetime members of the portfolio builder. Okay, and once again, guys, it's all tax deductible as long as you do it right. Okay, so just some examples here, but really want to touch on inflation, guys. And I think this is the the number one thing I talk to so many people about that they just don't understand how much of their money is being eaten alive by inflation or burned up by inflation. Okay. Uh, so it's pretty wild. The average inflation that I can see, real inflation, okay, not the government metric BS, um, is really kind of between 7 and 8% if you're inland. If you're on the coast, it can be as high as 10. Okay, so let's just say per $100,000 you have sitting in the bank right now, or just sitting in a brokerage account because it's not allocated. Okay, you're losing about $7,000 to $8,000 a year to inflation. Okay, and if you have $1,000,000 sitting in the bank account or brokerage accounts, that's 70 to 80K a year you're losing to the buying power of inflation, guys. So put your money to work, right? You always want to have your money working for you so you can eventually not have to work for your money. Okay. And you always want to take the safest route with that. Okay. That will reduce your stress. Okay. And it's going to help you develop confidence in the long term, right, on what you're doing, why. And risk management is just a beautiful thing. There's a reason why all of this, the most successful investors on the planet use it religiously. Okay. Unfortunately, 90% of the retail investors I've met don't. So that's kind of part of how we fill a void there, and show you guys how to use proper risk management. Okay. All right, folks. So that is it for me. I'm going to go back to a slide really quick before we go ahead and close out. I'm going to leave my number up on the screen. If you're not signed up, feel free to go ahead and give me a call. Would love to work through any questions you have, show you my portfolio, see how everything's worked. And my number, once again, is 505-322-7515. And once again, folks, my name is Dean Gallagher, and the number is 505-322-7515. Thank you so much, team, for your time and attention. Let's take a look at the portfolio one more time before we close out here. Okay. And let's go ahead and expand this so you guys can see this a little bit better. All right. And give me just a few seconds to do that here, folks. That way you can kind of see what the P&L looks like a little bit easier. So I'm just going to my Thinkorswim account here, going to apply some settings so you guys can look at these numbers a little bit easier. Okay. And you can see right here that the overall profit loss from last Friday to today was a little over $9,000 generated in profits. Looks like that might click to 10 here while we're watching it. Okay. And over the past 45 days, total profit has been $61,000. $61,082.44. We just popped over the $10,000 mark in profit from last Friday to today. So not bad. Got to love the $10,000 growth days of the portfolio, outperforming the S&P 500 with our put protection. So we are firing on all cylinders here, folks. Look forward to showing you how to do that as well. So thank you very much. Once again, 505-322-7515. If you do have any questions, have a wonderful day. Thank you so much for your time and attention, folks. We look forward to helping you grow your money in the safest manner possible. Have a great day.